The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. We have plenty to talk about on Wednesday's trade. We saw overall another down day, but I'll say quarter beans. It was a slight win in my book, considering everything that's floating around this market trade. We were only lightly lower there for the most part. We have a lot to look at, though. Let's dive in and get thoughts from Mike Zuzolo, Global Commodity Analytics, joining us here on the program today. Mike, great to catch up with you again. And I guess just to start, I'd love your thoughts there. I feel like it was a slight win on the day when the dust settled, considering just everything that's out there swirling around the market right now. But what's your take on things?
Yeah, I put in my blog Tuesday night to clients and subscribers, Jesse, that I felt like the trade was back to not looking at anything but negative to demand mindset, regardless of whether it's macro demand, trade demand, or whether it's physical supply demand fundamentals that they aren't happy with the U.S. exports for agriculture. Well, I think that thesis was tested and it held up pretty well because it was, as you say, a very different trade today versus the overnight trade Tuesday night. I think it was because we saw those unknown sales of corn and beans come in. And I think that just simply put, created an environment where those new shorts realized that they had stepped in it. It didn't smell very good on their shoes and they went ahead and got out. And so I think that's the heart and soul of this market right now, is that we continue overall to face a supply and weather driven market in terms of upside price movements. Those price movements, however, are almost quickly within 2 to 3 sessions sold then. And the trade feels confident in selling because there's no one that's going to fight them and the demand's going to stay poor. And I think that's the battle we fight, especially now that we're getting ready to add new supply in the form of new acres here in the Northern Hemisphere. And I think that's really the best way to kind of sum up everything going into the Easter holiday, going into the 3-day weekend. Wheat still needs to lead this show in terms of upside. And I say that especially given the crop conditions. We can talk about it if you like. And especially given the fact that Hutchinson, Kansas tonight is expected to be anywhere from 24 to 27 degrees, depending for a low, depending on what model you're looking at. And those are actual temperatures. Where were the weather bulls at? Where was the fear factor on freeze damage at today? It was MIA. And I think it just goes back to this demand negativity that the trade continues to face.
Well, and you mentioned the acreage numbers, and obviously all the numbers that we got Friday between the prospective plantings, quarterly grain stocks. We can sit and debate them all we want, but the numbers are the numbers. So how does the picture look now? And I think to your point, also heading to Easter, I wonder if traders are maybe just a little cautious here with a 4-day week on our hands here today.
Yeah, they should be. I mean, especially given where we come from when it comes to the grain stocks report, the weather, when we talk about the spring wheat and corn acres. We've seen OPEC cut a massive amount in their production. And now we're starting to see a situation develop where the trade is seeing gold almost take out its all-time high. I mean, there are several major features in this trade right now, along with the wheat crop conditions, that would say supply-wise and investment-wise, you shouldn't be selling this market. But yet we did have, and I think this is a player in the price action and the market sentiment. We had a really good special report done by USDA last week. It was right at the end of the month, and they talked about our export trade now versus back in the early 2000s. And the numbers really did surprise me because I knew we had lost some market share, but we were essentially 40% of the world wheat exports back in 2000. That's been cut down to 20% as of this past year. Corn, it's been even worse. We were, as of 2006, we were 71% of the world exports of corn. Last year, that had been cut down to 30%. So when you see statistics like that, and then you see this deglobalization move that Russia, China, Saudi Arabia, Brazil, India, some Central American countries, you and I have talked about this new East, new West trading bloc, political blocks, friends versus enemies type mindset. I think agriculture is right in the center of that. And that's really what's overlaying and burdening this market right now, I think, from a sentiment standpoint.
Mike, I want to get to some charts and walk through some of the latest analysis you're working on. I'll pull up on the video feed. We'll look first at the Bloomberg Grain Commodity Index monthly chart. And as we think about just where things stand now after these big USDA reports and the trade action we're seeing this week, what are you seeing here? And walk us through some of your thoughts and analysis.
Yeah, this is a nice way to dovetail what we were just talking about, Jesse. This chart really shows nicely a 4-year cycle from low to low. And I have to say, compliance would say don't trust cycles. And I agree with that. Don't trust cycles. Every year is different, but I still think that cycles are beneficial and need to be looked at. And what you see, and there's a cycle low going all the way back to 2002. I just expanded this chart a little bit so we could see it better. But essentially, every 4 years, we'd see a low to low. Starting in 2002. That got elongated where the low from the number 5 is from 2020. We should have made a low in 2018, but 2019 and 2020 was the COVID and some other issues that came in, and we elongated that low out. So if we mark a low from 2020 and we think we should be up 2 years and then down 2 years for that 4-year cycle, we've passed the cycle high time period. And indeed, we did put in that major high last year in 2022. So now what I'm thinking about in the analysis, going along with what we just talked about, going along with the supply and weather-driven market, could we go sideways to lower going into the rest of 2023, but then that sets us up for a fresh cycle low in 2024. And I think that's something really to watch for. And I think it just reinforces my belief and my analysis and mindset that we really want to play long ball here, medium term. We're price takers, yes, but we also can store grain. And I think this is where 2023 could be a really tough year from a standpoint of figuring out the trend. But by the same token, it may be setting us up finally for some demand lows. And I think with the way the gold is acting, why is gold going so high? Because I think the market's lost confidence in the dollar, which means they've lost confidence in the Federal Reserve. So unless bond yields start to go higher again, I think the dollar is more subdued now and the trade feels more confident being long gold. That means that interest rates are probably not going to come down, and that means inflation's probably going to linger. And that kind of adds to the idea that if the dollar softens more in 2023, we could be laying the groundwork for a nice demand-led market in 2024. So the point of this chart is watch the point where this wedge is. These two red lines came together. We still haven't defined a trend. Don't think that the trend can't go down. Take the trend at face value because of what I just described, but then look forward to 2024, maybe a little bit better market action.
I want to talk a little specifically first, soybeans. I know you and I have talked quite a bit here recently about that December corn, November bean ratio. I know we've seen a decent rally back in this soy complex here as of late. Obviously, we got lower acreage numbers from USDA when it comes to soybeans. So what is your take in this soy complex as a whole right now, Mike?
The acreage numbers and the grain stocks numbers breathe some new life into the soybean bowl. And it was just this week, in fact, I think it was just on Wednesday today that the May-November soybean spread went above $2 a bushel premium. The May, that was a fresh contract high. And I think that's due to the reports from last week. I also think that's due to the uncertainty about Argentina. I'll talk about that more in a second, but I think the other thing it's due to is because the Brazilian currency has just struck an 8-week high against the US dollar. That's kept the funds long the beans more than the wheat and the corn, I think, Jesse, because of that Brazilian currency being more expensive, making our beans more attractive potentially to Mexico and China especially. So I think this is where, again, we see a very strong triangle formation forming again. It's been, going sideways essentially since 2023 started. Yes, we've had some deep dives to the downside, but everything's come back up above those lines. And so now we're back to a point, and I think that point, once again, needs to be taken at face value. Whichever way we break, I will take that as at face value and get some, either roll up my puts that I already have in place or get in contact with the producers that haven't done their recommendation yet.
We're having a conversation today with Mike Zuzolo of Global Commodity Analytics. Mike, I want to touch on the corn market real quick as well before we talk crude oil. With corn, after the reports here, looking at the situation, 560 December corn on the board. I wonder your thoughts with what you're seeing on the charts and just all the action in this corn market. It feels like we're just kind of going to sit in a range here, potentially waiting on U.S. weather moving forward.
Yeah, I think that's the key is that the end users are probably needing to buy. The farmer is probably not wanting to sell until he gets safely planted in the new crop. And so I wouldn't expect the basis to give way that much more than it did after the grain stocks and acreage report. I think you also have set up now a very tight old crop scenario that any weather delays, I'd say after April 20, April 25, I think that's when the market tends to get a little bit more nervous about losing peak yield on acreage base, Jesse, and probably will start to question whether we can get 92 or whether it's going to fall back towards 91. And I'm more like a 90 and a half number still. I can't get off that number for some reason, and the weather pattern would suggest I'll be more right than wrong if it holds up here another 2 weeks. So I think you're right. They're going to try and bid up and get some in bushels from producers, especially if we see some weather planning delays. Otherwise, we'll probably wait for the wheat. We've got to wait for the wheat because the wheat corn spread is down around 35 cents. And so wheat's a feed grain again, and the trade just sees that. And we cannot get support from the European wheat or corn markets. And I did some number crunching before I went on with you today. A month ago, the European wheat premium in Paris futures minus the Merc here in Chicago was $1.37. It's currently now down below 50 cents. What is going on in the European wheat and corn market that I don't understand? Is it we're getting more Ukrainian bushels out? Is it that the demand is just shot at this point, or are farmers selling over there? But that there's something going on in that European market that continues to weigh on our prices here.
We'll have to watch that very closely. I want to give us time to talk crude oil and also the livestock trade here, Mike. This crude situation, I hear a lot of traders screaming that we're going to go $100 a barrel with the OPEC cut and this and that. And we saw the big run up to start the week, but then we've kind of held this $80 range, this top end of our range. So my question to you, and I'll pull another chart up here on the video feed that I know will tie into this, looking at distillates, but with crude, do we need to pump the brakes a little bit on $100 crude oil? What do you think?
Yeah, I think you're right back to where you were with this demand market versus supply market. That's where the crude and the wheat are at the focus. I mean, they're at the apex of all this, Jesse. I think you're 100% right. I think very sincerely that you've got to get above 85, 85.50 and WTI to be able to shoot towards $100. I think you've got to have the charts on your side at this point and the momentum. I'm not saying you can't do that, but I would also say that it's probably going to be led by the product markets or something like that. And this is where this product market, it's really making me nervous now from a standpoint. The distillate stocks in red, the unleaded stocks in blue, notice that both of those are now making new 2023 lows in terms of supplies. So not only do we have, and this fits in perfectly with the livestock market, not only do we have the equities and the financial markets to worry about, but now we have to worry about summer gas prices going higher than the fundamentals would suggest. We're all talking recession. We're all talking weak demand. But these charts right here could suggest we need to ration more demand because it's summer driving season. And so I see more and increasing headwinds when it comes to the livestock. I actually think the distillates and unleaded numbers that we see here on this chart could actually provide a reason for the crude oil to go higher, that or the geopolitics. So 85.50 close above, I can tap into the idea 100 to 110 WTI.
Well, and you mentioned the geopolitics of it all, and we don't necessarily know the reasoning, but I think we can maybe infer that OPEC said, okay, to the U.S., you're not going to fill the Strategic Petroleum Reserve at $67. Well, we're going to cut pretty close to that amount that you needed to get and shoot the price back up. I mean, it just it's one of those like unspoken things. I feel like, Mike, it just seems like that's part of the reasoning behind the move by OPEC.
No, that's right. We're not playing Texas Hold'em anymore with China and Russia and Saudi Arabia anymore. This is just open cards here at this point. They are moving in a strategic fashion, and they want to keep our inflation elevated so that it puts more pressure on our central banks. Why would they want to do that? Simply put, Jesse, because we've put unbelievable sanctions on them, and our central bank monetary policy has raised interest rates so high their inflation is intolerable. And so they're saying, we're going to feed you some of the same gruel that you've been feeding us. And I hate to be so blunt about it, but in business terms, I think that's exactly what's going on here. And that's where I'm saying to people right now that call me about the precious metals, I don't think this is a one-off with this market moving higher. I think this could be a 2, 3, 5, maybe even 7-year cycle in these metals, because the central banks of the world in the West have kind of lost control of controlling inflation. And at the same time, our former allies are trying to pump inflation into our economy. So that's a big difference from what we're used to in the last 40 years.
Very big difference. You mentioned how crude tying in with livestock. I want to pull up the April live cattle continuation chart on the video feed. Cattle, what's your thoughts? What are you seeing throughout the cattle trade right now this week?
Short term, I'm not real nervous because the Kansas trade at 167 and whispers of Nebraska as high as 170, 172 are probably closer to being accurate than not. And so I think the cattle market's very solid because the cash market's underpinning us. Having said that, as we get into the beginning of the summer grilling season, if we don't see the equities markets and we don't see the gas prices playing fair and playing nice with consumers' pocketbooks, I am starting to get more nervous about that cycle high that I see coming this year, coming earlier rather than later in the year. And that's kind of the tipping point that I see is what's going to make or break us. And I think it's those two things: the stock market and the prices for fuel. And that would make sense, because the higher the fuel prices go now, I think it would actually create more pain in the equities markets, because it's going to create more problems with corporate profits. And I think we really got to be aware that we've got hogs now down to $70 again. It's going to win the featuring battle this summer if people buy it. And I think beef will be really hard pressed to keep the same level of demand that it has the last 2 years.
You mentioned the hog market too. Felt like April hogs just a technical bounce on Wednesday after setting another new contract low, because we saw that pressure in the deferred months throughout the trading session as well.
Yes, and we're at a point now with April going off on I think the 19th. It's right there with the cash index, but the next month is May, and it's running an $6 to $8 premium to the cash index in April. So we need April to move up towards May, or I'm fearful we'll do the same thing we just got done doing once May becomes the lead month. We just can't get a grip on the demand. And the USDA, in their updates for the retail featuring report last Friday, they said the featuring went down. And I thought to myself, how can that be with Easter and with the price of pork? How can we see weaker featuring in the pork side? So I think that really shot us to begin the week out. And that's why we had that bear spreading where the front end went down more than the back end. And I think, as you say, we're reversing that. I think just position squaring as we get ready to go in the holiday.
Mike, great thoughts as always. Before we wrap it up, anything final for us here today?
I wish you a happy Easter, Jesse, and I hope all the viewers out there have a blessed Easter as well. And thanks for having me.
Well, we wish you the same. And real quick as well, if folks want to reach out to you, check out your analysis, what's the best way to do that, Mike?
Go to the website at globalcomresearch.com and sign up for a trial, or give me a call at 866-471-2588 if you have a specific question. Be happy to talk to you.
globalcomresearch.com. Again, Mike Zuzolo, Global Commodity Analytics. Happy Easter again, sir. Thanks for joining us. We'll talk to you next week.
Thank you, Jesse.
Let's go do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.